Welcome to Ray CRE Broker, and this is your guide to smarter retail property ownership. Today we're talking about something that sounds simple, but in my experience changes a lot, and that's knowing your numbers. Whether you own a suburban strip center, core retail, or even a flex office center, understanding a few key numbers can mean the difference between quietly losing equity or setting yourself up for long-term success. So here's the truth. Most owners I meet aren't focused enough with their numbers. They bought their property for stability, income, maybe even legacy, and in most cases, at least for a while, everything feels fine and is going great. The rent checks steadily come in, the property looks active, and their bank account isn't looking too shabby. But what I've seen time and time again is that trouble doesn't show up all at once. It builds slowly, quietly, underneath the surface. And if you don't know where to look, you'll miss it until it's much harder to fix. There are a few numbers that every owner needs to know. Not to complicate things, but to simplify decision making. Number one, NOI, which stands for net operating income. Your NOI is your property's lifeline, right? It's your total income minus your operating expenses before mortgage or debt payments. It tells you what your property actually produces. If your NOI is shrinking or staying flat while costs rise, that's your first sign that the asset's health is slipping, even if the property looks fully leased and active. A fully leased building with poor NOI is simply like a really nice car with a problematic engine. It looks good until you try to sell it or refinance it. Number two, return on equity. This is a big one most people miss and why it is really important to track. As you pay down your loan and your property value increases, you build more and more equity. And that sounds great, right? But if your cash flow doesn't grow at the same pace, you're getting a lower return on your equity year after year. So imagine you had $2 million sitting in your property, but you're still only making the same $100,000 in net income you made when you had half that equity tied up. You're earning less on every dollar you have invested. Your money's working half as hard, but you're still carrying the same ownership risks. High equity, low productivity. And that's a silent threat to owners who like to set it and forget it. Number three, debt service coverage ratio or DSCR. If you have a loan, your debt service coverage ratio is the bank's way of asking, can you easily pay me back? Technically, it's simply your NOI divided by your annual loan payments. A healthy DSCR is usually around 1.25 to 1.5, and that means you're generating 25 to 50% more income than you need to cover your loan. If you're slipping below 1.2 or closer to 1.1, you're not leaving much room for error. And a couple missed rent payments or unexpected repairs could lead you into trouble. Number four, occupancy and lease expiration schedules. It's easy to feel confident when your center is 100% leased. But the real question is, when do those leases expire? Are they staggered out, or is there a cliff coming where 2 or 3 major tenants might leave at once? Managing lease expirations strategically gives you the ability to control your property's cash flow and your exit strategy far better than reacting to surprises. Not long ago, I met with an owner who thought everything was going great. On paper, 100% occupied, but in reality, half the leases were expiring within 12 months. 2 long-term major tenants hadn't had a rent increase in 4 years, and a couple of tenants were paying below market rents by at least $7 per square foot. It wasn't a huge disaster, but it was a ticking time bomb. Because no one had been watching closely, they were heading toward further loss in income and overall value, plus losing control in the event for a successful exit. We caught it in time and put in a strategy for success, but it's a good reminder. Visibility equals control. Now, keeping track of your numbers may seem intimidating, but it isn't as complicated as it sounds. You don't have to become a CPA and you don't have to obsess over spreadsheets. But knowing your NOI, Tracking your equity productivity and keeping an eye on loan health and leases is really smart stewardship of your investment. What's remarkable is that unlike stocks and bonds, you actually have some control over how your investment performs. You can't treat your property like a lottery ticket, and you got to start managing it like the powerful investment it truly is. And that's all I got for today. So please like and subscribe as we continue our discussion about strip center investment. And feel free to reach out to me at any time. You can find me at www.CREBroker.com or connect with me on LinkedIn. Thanks for joining me today. And next time, we'll talk about another big mindset shift. Why you need to treat your property like a business, not just a mailbox. Until then, stay strategic and make more money on your deals.